Okay, I have another good one hot off the press. This video, let's get right into it. It's called the top 10 most important frequently asked questions that home buyers ask. Gonna go ahead and whip through these 10. I'm also gonna make the PDF available for you in the description so you can download it and have it at your disposal. Now, number one, how much house can I afford? Well, you won't know the answer to that until you go and get a pre-approval. Most buyers start their search online. They find all of these beautiful homes. They don't know whether or not they can afford these homes. They just know they look great. They're like window shopping, let's put it that way. And then when they actually go out to look at the home and now they want to qualify for the home, they find out that the house they was looking at is really more than what they can afford based on what their income is. And then in some cases, it doesn't matter because I do have a lot of buyers, they pay cash. So cash is always good as well. But if you want to know how much home you can afford, number one, go and find a lender or two, get pre-approved. They know especially if you're going to be buying a house soon, don't go and uh, you know, have your credit pulled if you know you're not gonna buy a house right now. At least if you have some idea. A lot of people use Credit Karma and all these other credit companies, which is just for you personally. The lenders have their own algorithm as to how they look at their different models to see if you're a candidate that will pay the money back. So sometimes there's a discrepancy in the credit that you pull versus the credit report that they pull. So just keep that in mind. But if you want to know how much house you can afford, then you need to go and find yourself a lender or two. And if you watch the previous video I said on how to, before you buy a house, I talk a lot about how to pick a good lender. So that's number one. Number two, how much money do I need to buy a home? This is going to include your down payment, closing costs, earnest money, inspections, and other upfront expenses. I always tell people in your bank account, the account that you will be using to do your home loan. Make sure you're not doing cash deposits, large deposits, especially money that you can't source. But if you get like direct deposits or you're getting payments from somewhere where that money can be sourced or you know where the money is coming from, that's okay. So when you get a loan, that's going to determine how much down payment and how much your closing costs are going to be. It's different for each loan. So we're talking about FHA loan, 3.5% down plus closing costs. We're talking about a conventional loan that's going to be 5% down plus closing costs. If it's a VA or USDA loan, zero down. However, you do have to pay closing costs. And then I want to mention here about the down payment assistance. A lot of times when people get down payment assistance, they say, well, my down payment assistance is going to cover my appraisal and they're going to cover my earnest. No, down payment assistance doesn't cover that. It will help you with your down payment and it will help with some closing costs. But when it comes to that initial getting under contract, you have to have your own earnest money. You have to have your own option fee. And typically, the earnest money is 1% of the sales price. Nothing is written in stone. Everything's negotiable. That's my disclaimer. I'm sticking to it. I'm going to say that in this video so that no one come back and say, you said it's 1%. Everything is negotiable in real estate. So just know that typically it's 1% of the sales price. So if the sales price is $400,000, 1% of that is 4,000. It needs to be in your bank account because when you submit the offer with your pre-approval letter, they're going to want to have that money sent over to the title company within 3 days. And then the option fee, it can range between, I don't know, $100 to $200. If you're competing with someone else, you may give a bigger option fee. That money goes to the seller, and it's to basically say, hey, Mr. and Mrs. Seller, I want to have the property inspection. In good faith, here's some option fee money. Just pull the house off the market for whatever many days you put in the contract. It could be 7 days, it could be 5 days, it could be 10 days, and you're going to have the home inspected. Once you have the home inspected, then you can make a determination whether or not you want to continue to move forward. If you want to negotiate with the seller to fix some big ticket items, maybe the roof needs replacing, AC needs replacing, hot water heater, plumbing, electrical, things of that nature. Not like cosmetic things like, oh, the paint is chipped, or oh, I don't know, a door stopper is missing. Those little small things. You want to look for big ticket items, foundation issues, things of that nature. So, how much money you need to buy a home? Just know that before you start, make sure in your bank account you at least have the earnest money. You have your option fee. You have money for an inspection. It's based off of the square footage of the house. You can pay anywhere between $400 up to $700 for that inspection. You're going to have to pay for an appraisal. Appraisal, same thing. It could be anywhere between $600 and $700. I'm just throwing out some numbers. I'm not quite sure what those exact figures are because if you get an FHA loan, the appraisal amount is going to be different from a conventional loan. So just know that before you start anything, have that pile of money sitting in your bank account, ready to rock and roll. That is totally separate from when they say we're going to give you an FHA loan and you need to have, say, 3.5% of your own money for the down payment sitting in your bank account already. That money needs to already be there of your own funds. If it's a conventional loan, you need to have 5% ready for down payment sitting in your bank account. And of course, when the lender gives you that pre-approval, they'll be able to tell you what your principal, interest, taxes, and insurance is, what your total monthly payment is going to be, so you won't have payment shock. You'll know exactly what to expect on a month-to-month basis for your home mortgage. So the answer to number two that talks about the down payment, how much money do I need to buy a home? Just make sure you have those things in place. Let's move on to number three. Do I need 20% down to buy a house? This is one of the biggest myths in home buying. Why do they say you need 20%? Well, the reason behind the 20% is so that you can eliminate what is called the PMI, which is private mortgage insurance. Well, private mortgage insurance, it's an extra insurance that you will pay to the lender to ensure that you won't default on the loan. If you default on the loan, that insurance makes them whole again. You can eliminate that insurance if you have a conventional loan, meaning it can go away. So the faster you pay that mortgage down within 79.99%, it depends on the lender. And if the value of the home goes up, you can get there faster as well. But if you pay more on principal, you can also get there. And that extra insurance it's based off of credit and it's based off of some other things too. But basically, it may be $125. It may be $150. It may be $160. But who wants to pay an extra $160 in addition to the principal and the interest and the taxes, and the insurance? And now you got the private mortgage insurance, but that can go away if you were putting 20% down. Now, another tricky kind of way to make it look and feel as if you put down 20% is to do something called a purchase money second or a second lien. How does that work? In order to do this strategy, you have to have good credit. And I'm talking maybe I want to say maybe 700 credit scores or higher. So what it is you get an 80% first lien. And now the lender is like, wow, this is great. That person's putting down 20%. They don't care where that other 20% is coming from. They just know that the bigger portion of the mortgage coming from them is only 80%. So it's at that point in time that you don't have to escrow for taxes and insurance. You don't have to pay the PMI. And this is on conventional now, not FHA, conventional. And then the second part of that equation is now you have to find a lender that you can get a 10% loan from or 15%. So it'll be to make up the total 100%, it'll be 80% first lien, 15% second lien, and then you come with your own 5%. Or you can do 80% first lien, 10% second, and then you bring 10% out of your own pocket. Either way, it will eliminate the PMI. You can see if it's worth it for you to do it that way or not worth it. Some people say, I want to have all my stuff in one. I want the whole big mortgage. There's some pros and some cons to that. So I get a lot of buyers that's calling me saying, hey, the taxes went up, my homeowner's insurance has gone up. We have all these storms, and the lender wants to charge me an extra $300 a month. I thought you said my principal and interest is never going to change, or my mortgage payment is not going to change. Why am I paying an extra 500 a month for the next year or the next three? Well, if the escrow account has a shortage, meaning that, let's say your homeowner's insurance for the year was supposed to be $1,500, and because of all the storms that we have here in Texas and hurricanes and all of those things, now instead of $1,500 a year, they bumped it up to $2,000 a year. And normally the escrow account has a cushion, like 2 months cushion for the insurance. But in this instance, the cushion is eaten up because now the taxes that were normally, say, $8,000 a year, now the taxes are like $9,000. So that cushion has been wiped away. So now the bank has to make up for that cushion. And the way they do it is they will increase your mortgage payment so that they can get a cushion back into the account. So at the end of the year, they're not short on paying your taxes and your insurance. So just keep that in mind. But if you break it out where you don't escrow for your taxes and insurance, and the only way you can do that is if you're putting 20% down, you have more control. So if you're a good saver, you're not a spender, and you're not going to spend the money up at the end of the year, when you get your tax statements, if they go up, then you just pay whatever that statement is saying that you have to pay at the end of the year. But if the lender has control over the escrow account, you have to pay whatever they tell you to pay. You're at their mercy. There's nothing you can do about it. You can cry from here until, the end, but end of the end. But anyway, just look at it this way. You don't have any control, but you have more control when you don't escrow for taxes and insurance. You just got to be disciplined enough to be saving every month that money into an account. But just know if the taxes go up or if the homeowner's insurance go up, you won't be on the hook for them slapping an increased payment on you, because it has really hurt some of my home buyers, and it's like they don't know what to do. I mean, they're frustrated, and they say they thought it was going to be for a couple of months, and a couple of them said, like, saying it's for the whole year. We don't understand why. Well, because taxes really went up and home insurance went up. Another thing, real quick on this, is people don't know that they can shop for new homeowners insurance. Just because you get the homeowners insurance when you buy the house, you're not stuck with it. You can still shop, replace that insurance, and get some new insurance. The only thing you can't replace is who you pay your taxes to. That's the other thing too, when we talk about bump it back up to number two, how much house or money you need, or how much home can you afford. It's going to depend on the community you move in. Each community has their own tax rate and the amount of homeowners insurance that's going to be charged. It's almost like a car. The fancier the car, if it's a sports car, you may pay more insurance versus someone that doesn't have something that's fancy. So depending on which community you're moving to, it's going to determine whether or not you're going to pay high taxes or low taxes. So we just finished number two, about the 20% down. Let's move on to number four. What credit score do I need to buy a home? Let me find my list. It is right. I think it's this one. Yeah, I found it. Okay. So we did number one, we did number two, did number three. Now we're on number four. What credit score do I need to buy a home? That's a tough one. I say it's tough because, again, it depends. Everybody's situation is different. Just like you have like no two fingerprints are the same. Everybody has a different fingerprint. Believe it or not, no two loans are the same. They may get the same type of loan product, like they may all be FHA loans, but there's always something different going on with each individual loan. So until you know which loan product that you're getting, meaning FHA, conventional, USDA, or VA loan, it's difficult to say because FHA is more lenient and VA loans are more lenient for the home buyer than, say, conventional. Conventional is tough, hard. Got to have, I mean, they're very strict with credit scores and debt to income ratios. Whereas like the FHA people and VA, you can write a letter explaining yourself for certain things and stuff like that. So again, it's going to depend. But typically, If you have like a 580, you're doing FHA, you may have to put more money down. Um, in some instances, it just depends on what your assets look like. So if you have like, 401k accounts or you have more assets and things like that, it can kind of help you balance things out. So once again, the lender will have to take a look at everything before they can actually tell you what the credit score needs to be, because there's no hard, steadfast, set in stone number, because depending on which lender you select, the credit score, it can change. It can go either way. So that was number 4. Number 5, how do I get pre-approved and why is it important? Like I said, you can't just go looking at houses and you don't have a number in mind. Should I be looking at $500,000 houses or $300,000 houses? And the only way you can find out is if you get a pre-approval. And if you don't get a pre-approval, most of the time, a real estate agent is not going to take you out anyway, just to blindingly go and look at homes that you can't even afford. And then only to find out they pull your credit and they do your debt to income ratio, and you have a lot of, say, credit cards that you're paying on, you have a lot of debt, or you just bought a car and that car was the thing that put you over. So it's best to know what can you afford. So when you're going out shopping for a house, it makes it a lot easier. So you want to get that pre-approval done. And then too, if you find a house, now you run the risk, like some of my clients almost did, of someone else taking the house, because now you got to go through the motion and the process of getting pre-approved. And if you take a day or two and then someone else comes along and the offer gets accepted, then now, you're kind of upset because you didn't get the house that you wanted, all because you didn't have the pre-approval letter in place in the first place. Okay, so number 6. What is the difference between FHA, conventional, VA, and USDA loans? That's kind of what I was talking about before. The major difference is the amount of money you're going to put down. Conventional, 5% down. FHA, 3.5% or 3.5%. VA loans, 0. USDA loan, 0. Those are those rural loans that's like out in like the boonies. And in certain pockets, you can get those USDA loans and there's 0 down. But remember, all the loans that have 0 down, you still have to pay closing costs. A lot of times people think, oh, I'm getting this house with 0 down. And in their mind, they're not even thinking about closing costs. So the shocker comes in when, for some reason, when they're getting their pre-approval, I don't know why they don't see that part. They see that, oh, I got closing costs to pay. Where did this come from? I thought it was 0 down. Well, down payment has nothing to do with closing costs. You have down payment plus closing costs. Please remember that. If you don't remember anything else, remember that. It's always down payment plus closing costs. Same thing with earnest money. Earnest money goes with the contract. It's just showing, hey, in good faith, that money will be subtracted from your total closing costs, though. So don't think you're just giving that money up and it disappears. It's sitting at the title company in escrow so that when they start balancing the numbers out at the end, that money will be subtracted from your total closing costs. Number 7, what happens after my offer is accepted? This is beautiful. I love this. This is where many buyers become anxious because they don't understand the process. And this is kind of what I was talking to you about. So let's do a role play. You have your pre-approval letter. You went to the lender, you got pre-approved, you have the letter, you know how much house you can afford. Now you're shopping for homes, you find one, beautiful. The letter goes with the offer, you submit it. The offer gets accepted. The seller says, hey, this looks good. We want to sell you our home. Now, what comes into play are those things we talked about before. You have 3 days to get that earnest money and option fee over to the title company. You may do it via cashier's check. Maybe you write a personal check. Maybe you wire the money over. But before you do any of these things, make sure you check with your real estate agent, check with the title company on the phone to verify, because there's a lot of wire fraud and people snatching up, your money out of the air. So you want to just make sure you check and verify. I think Ronald Reagan said that, but you want to check and verify. I'm dating myself. But anyway, so that money needs to get over to the title company immediately. Once that money gets to the title company, while all of this is going on, now you need to order your inspection. So you'll have the call your inspector up and say, hey, I'm buying this house. I need you guys to go out there and inspect this home for me. They'll try to get out there within a day or two. They inspect the home and then they go over their findings with you. And if you put in there 7 days, then now you get with your real estate agent. Y'all going to talk about if they need to, I don't know, fix the AC or fix the electrical box or paneling or something like that, or put a drip on the hot water tank, whatever comes back. Then your realtor will get with you and y'all will negotiate with the seller to either give you some money to fix those things, or they say they'll take care of it themselves. So once they finish doing all of that good stuff, y'all come to a happy medium. Now the next phase is to have the lender order the appraisal, because they want to make sure that all that's taken care of. Because why spend $700 for an appraisal when at the during the option period you decide you don't want to buy the house? Who wants to spend that money out of pocket when now you're not buying the house? So it's best to wait to order the appraisal until after both parties have agreed that we're going to continue to move forward. If you don't move forward, then what happens is the earnest money is returned. You lose the option fee money because it was the cost of doing business. The seller politely took their home off the market for you so that you can inspect the property, and then you get a chance to either buy or change your mind. But if you continue to move forward, like I said, inspections are done with, the appraisal is ordered. Later on, they're going to order the survey. You need to get your homeowner's insurance in. I talked about that in the previous video. It can hold up a closing. A lot of times people forget to get that homeowner's insurance in. You want to make sure you get yours in. Don't forget. And then after the homeowner's insurance is turned in, you're looking for a conditional loan approval. Again, watch that video. It's very thorough when I talk about the conditional loan approval, because a lot of people think the pre-approval, hey, I'm pre-approved, that's great. Yes, pre-approval is just to be able to submit an offer with a letter. Conditional loan approval is really good. It gets a little bit better because now they've verified your income and your place of employment. Now they're looking to get the other conditions in. So it's an approval with conditions. We need a copy of the appraisal. We need a copy of the survey. We need the title commitment. Maybe they need an updated bank statement. Yeah, if you were divorced, maybe they need a marriage certificate. If you're getting child support, maybe they need child support, documentation or student loan stuff. So that's a loan approval with conditions. And then what you're really waiting for is something called the clear to close. And that's why I said that's the most important part to me of the home buying process. It's overlooked. It's not talked about often, but it's where fights happen and showdowns happen, and realtors, they're, you know, getting into arguments and stuff, and everybody's calling the poor loan officer, fighting and arguing with the loan officer. They're at the mercy of the underwriter. So, long story short, you're looking for that clear to close. If you watch that other video, you understand what I mean by that. And I have this book called The Calm Close. It talks about how to be calm during your closing, and I have to go through all those things. And then there's some information that will help you through this process as well. Okay, so that was number 6. Let's move on to number 7. What happens after my offer is accepted? I just told you pretty much what that was. Actually, we did number 7. I'm sorry. Number 8. What are closing costs and who pays them? We kind of talked about that one too. Closing costs, you pay them. Well, yeah, you do pay them, but you can have your realtor ask the seller, hey, can you give us some assistance with the closing costs? They can write it in the offer that you submit with your pre-approval letter. Maybe the lender told you your closing costs were $12,000 and you say, well, I need about $6,000. You don't want to ask for more than what your closing costs are, because that money will be left on the table. So you can ask for $6,000, you can ask for $8,000. Typically, if it's an FHA loan, it's 6% of the sales price that they can give you max. If it's a conventional loan, it's 3% of the sales price max that you can ask the seller to contribute. The other thing is if it's new construction, a lot of times the builders will pay for all of your closing costs, which is a good thing. And sometimes there are down payment assistance programs that will pay for all of your closing costs and contribute to some of your down payment or pay all your down payment as well. And then if you have a family member or relative, they can contribute to paying your closing costs and down payment. So it's so many ways you can structure a loan. Again, it depends on what your needs are, and you won't know what those things are until you actually apply to get pre-approved because there's so many steps, there's so many moving parts, so many variables, so many unknowns that it's difficult to just say, okay, credit score needs to be this. This is how much you're gonna bring to closing when you don't have a property that they can base it off of. Okay, this is the property. These are the taxes. This is the HOA. This is how much uh things are gonna cost. So you need to have a property to kind of get an idea. So at least if you have a property and we're talking about okay, approve me for the maximum amount, you can at least get an idea of what it costs by that property and then maybe something a little bit higher, but you'll get an idea, which would be great. Okay. Number 9, what should I never do during the mortgage process? Ah, hmm. Buyers need to know what actions can jeopardize the loan approval. This is a real good one. Okay. I do have a checklist of things that you shouldn't do, but right off the top of my head, the first thing I'm going to tell you is don't put cash deposits into your checking account. You don't want to go dumping cash. Sometimes people sell stuff. Let me just back up. You don't want to be buying cars. You don't want to be furniture shopping. If you buy a new construction home, the house is so pretty. Sometimes they're so big and beautiful, and you may find that there are sales. People have these sales, and they say, "Hey, come on in. There's no interest for 3 years." And your lender won't find out because they end up doing a soft credit pull, but the lender can see that the credit was pulled at a furniture store. And the reason they're going to know this is because towards the end, when it's time for them to clear out all your conditions and issue the clear to close that I told you about, they're going to do 3 things. And these are the 3 things you have better not messed up or else you're not going to close. That's just it. And that's why I say it's the most important part of the whole transaction, the clear to close. That's why you don't order movers, you don't do vacation time, you don't do time off from work. Because if one of these 3 things is out of place, it's not that you can't fix them. Sometimes you can, sometimes you cannot. What am I talking about? The first thing they're going to do is they're going to do a verification of employment. They're going to want to see if you're still gainfully employed. Do you still have a job? I've had people buy new construction and say, I just get laid off. We're supposed to close next week. I'll just get a new job after we close. Well, they're not going to release the clear to close because once they do the verification of employment, they're going to find out that you're not gainfully employed. So there's that. No more loan. You can't close. Number 2, they are going to do a soft credit check. They're going to check and see if you went furniture shopping or if you added any new debt. Don't do it. Don't do it. Because if you do, you know what's going to happen? It's not going to be that you can't get the loan. If your debt ratios were already tight, what's going to happen is it's going to bump your debt ratios up higher past what the loan requires, which means you now can't get approved and you won't get the loan. Or maybe you don't have any debt and it bumps it up. They still have to rework all the numbers and stuff, all because you went out furniture shopping too soon because you were getting such a deal on that interest that you didn't have to pay that you just had to have it. And they said, don't worry. And they may be telling the truth. They're not going to charge you for 3 months up the road, but the lender is going to do a soft credit pull and see that you went furniture shopping. So don't do it. That's number 2. And the final last thing that they're going to do is they're going to ask you for updated bank statements. This is a big one. This one happens all the time, more often than I can imagine. But you can't be dumping large about to cash into your account thinking that you're going to get away with it. Because what's going to happen is the lender is going to request an updated bank statement. And what happens? I get my clients, they'll say, I've already given them an updated bank statement. Why do they want my bank statements again? And they're just hooping and hollering and yelling and shouting. And I've already told them at the very beginning now, we're singing Kumbaya, we're having fun, you having fun, I like you love me, we all having a good time. And I don't want you looking at me side-eyed when they ask you for this updated bank statement, because if you refuse to give it to them, I know you did something you weren't supposed to do. So what do? They have garage sales. They sell jewelry. And what do they get? Cash money. And what do they do with that cash money? Dump it into the bank account. It's not seasoned. It's not sourced. Now you got to try to explain to the underwriter, where did this money come from? And the reason you're fighting so hard is because you don't want to have to explain why you did what you did and that you have no proof as to where this money came from. No paper trail, nothing. You just cash. Or somebody say, hey, I want to help you out with buying this house. Here's a gift. You go $2,000 or $3,000 and you go dump that money in the account. You can't do it. So those three things can really hurt you and really mess you up. And you won't get to clear the close, and you done spent money for earnest money, you done option fee money, inspectors, you done had appraisals done. It could be a big old ugly mess. So don't do it. And then, of course, sometimes if the clear to close isn't issued, the underwriter may be waiting for you to turn in some documents, and then everybody want to call and bug the loan officer, poor loan officer, because they're at the mercy of the underwriter and then poor title company because they don't know anything. They're just sitting on at the end waiting to receive you and have you sign out your documentations, but they're just calling the lender, calling the lender, calling the loan officer. Then the buyer's calling the loan officer, calling the loan officer. The loan officer doesn't know anything except for what the underwriter is going to communicate back with them. So go watch that video and you see what I talk about in that. So those are some of the major things you don't want to do so that you don't mess up your loan. Okay. And then the final thing is, how long does it take to buy a house? That's a really good one. So buyers, they want to know the timeline from pre-approval to getting the keys. So this is the deal. Typically for FHA, I like to give the lender anywhere from 30 to 35 days. Sometimes they can do it a lot sooner. Just say max 45 days. If stuff is happening, typically they can do it within 30 days or less. And believe me, they're gonna use all those days because your documents are gonna be going in and out, in and out. And every time your file goes in, the processor tries to do one and done, get everything in because the underwriter is not just working on your file, they're working on maybe 500 other files. So and then if it gets to the end of the month and you have to go in and out, you might as well get an extension because now you thought you were going to close on a certain day. Now you're not going to close on that day and you need to get an extension so that you don't be out of contract and the seller don't change their mind. So you need to get that ahead of time too. That's why you don't order movers. You don't order vacation time. You don't take time off from work because any and everything can happen unless you get something called the CTC, which is the clear to close. You will not close. Period. End of story. End of discussion. There's nothing else for us to talk about. Okay. So again, how long does it take to buy the house? It's when you sit on stuff, if they ask you for things and you went in your spam and you forgot about it and you say, oh, I'll get to it in a couple of days, it's eating up. Just count that 30 days subtraction. I didn't do anything for 2 days and I got 28 more days. They ask for something else. You waited 2 more days, subtraction. Trust me. Then when you get to the end, now you're rushing. Oh, I need to, they say, they'll call me. I've been waiting on your buyer to send this thing in for a week now, a whole week. And then, of course, I already told you, homeowners insurance can be a way to hold up a closing too. They can want to issue to clear the close, but your buyer hasn't sent in the homeowners insurance yet. Well, it's important because the lender is going to be the lien holder, and they need to put the loan number on the homeowners insurance and a mortgagee clause on there as well. So those things can hold your closing up. And like I said, to buy the house, it could be 45 days. Oh, this is what I wanted to say. Sometimes you'll get lenders that are saying, we can close you quick. We can close you in 10 days. It's very fashionable. They want to say they pride themselves on being able to close you fast. You don't want a fast closing. Any and everything can happen. And if you wrote in the contract that you're going to be doing a fast closing and there are complications and you gave earnest money and in there it said you were going to close in 14 days and you don't close in 14 days because it's going to take another week, you can possibly lose your earnest money. So you want to give the lender as much time as humanly possible to close your loan. And guess what? If all is done and they finish early and it was a simple file, you can request to close sooner. Say, hey, we got done in 14 days. Can we close, sooner? And trust me, everybody wants to close sooner. They'll say yes, and you just close sooner. But don't fall for the let's close quick lenders, because any and everything can and any and everything will happen. So that's all I have for you for today. I'm going to make this a downloadable PDF like I told you, and I will see you in the next video.